Feroze Azeez, the joint CEO of Anand Rathi, joins us this morning. And Feroze, good morning. Thank you so much for taking the time and being here with us on News 9. I want to first understand from you that are we seeing some sort of a correlation in the mixed signals that markets are giving us? And do they have something to do with the Indian economy? And I'll tell you what I'm trying to base my argument on. First up, the Indian rupee has been under pressure. In fact, this morning, it has officially breached that 90 rupee mark, now at 90 rupees and 14 paisa per dollar. Then, of course, the trend that we've seen in gold prices, even though they had slightly corrected yesterday, gold prices overall as a trajectory continue to rise. And, of course, that is leading to export and trade deficit pressure as well. In fact, export figures came down about 11.8% in the month of October, and the trade deficit has actually widened to about $41.7 billion or so. Moreover, we are also seeing, despite the high growth that we saw, 8.2% in Q2, we are also seeing that GST collection is growing slower than earlier at just 0.7% for the month of November. And of course, low inflation and high growth is also likely to potentially confuse the Monetary Policy Committee when it arrives at the rate decision by end of this week. So overall, is this sort of mixed signaling that we are seeing from India's macros also reflecting in Indian stock markets?
Yes, absolutely, Karthik. See, there's such high frequency data which comes when it comes to different variables. So it becomes high frequency even if one variable drives the market for a specific period of time. So yes, there has been some degree of negative news, especially on the rupee depreciation side. Of course, RBI stopped intervening with rupee, which I think could be a good strategy from an export standpoint, export competitiveness standpoint. Of course, from a sentiment standpoint, it's a very bad strategy. That's point two. Point three, I personally think that rupee will start to stabilize because the current account and capital account both have had outflows. But the capital account, which is what I mean by FII starting to buy Indian stocks, will happen in the next couple of months, is my basic hypothesis, because they've dried up almost most of their frothy ownerships, as we call it. So I personally think that will be your support to the rupee in the next few months. So I personally think that the macro variables, especially like you said, the monetary policy would be a little confused. Inflation has been tamed reasonably well. And of course, the growth has been very good. The nominal growth hasn't been as good because the inflation hasn't been that great. So, but I think the surprise of the GDP growth number didn't get the momentum it needed. Market started slipping back from 26,300. There is some degree of resistance. The lower volatility, the implied volatility, which you spoke of about 11, which is what uses the December month options are used to work backwards to find out the India VIX, throw up a very low volatility. That means we're going to be range bound. So not too much for the trader, but great environment for the investor to build positions, especially after a 1 year time correction.
What should those positions really be, and which are the themes that those investors, I understand that it's going to be low volatility is bad news for traders, but for investors, again, you know, if you just look at data from this week, on Monday, Sensex and Nifty had touched their lifetime highs. In fact, Nifty 50, as you mentioned, had breached the 26,300 levels. And then yesterday, we saw a massive correction. This also happened to be Nifty expiry. And this morning, again, we are seeing markets open flat, despite the fact that US markets that India used to take more sort of solid cues from, is working pretty much, not in tandem with what we are seeing on Wall Street and the Lal Street. And then, of course, some of the sectors that that many experts said that are likely to outshine continue to be the bank Nifty, the banking financial services. But we are seeing that even that consolidation is now building at levels below 60,000. And Nifty IT is about 9,000 points below its 52-week high. So you're saying that investors could take positions. But in this sort of confused setup, what kind of positions and which thematic sectors or stocks are investors likely to place their bets on?
Yes, Karthik, before I come to your specific question of sectors and theme, one hypothesis which I tested, which could be a great foundation principle, is when the markets are up, don't buy too much direct equity. You would rather take a mutual fund kind of a route or a sector index, which you can buy. Why is that is, you would have seen during this latest rally and markets are at the peak, but portfolios are not at the peak.
That's right.
Because when you see markets are high, if you start buying direct equity, then what happens is you're buying some really expensive stocks. Like if you ask me the same question in February this year, when the small caps and mid caps had corrected, I would say that the tilt should have been towards buying individual stocks than buying mutual funds. Today, if you see my mutual fund basket, 14 scheme basket, is outperformed Nifty by about 3-4% for the last 1 year.
All right.
But a direct equity portfolio has underperformed Nifty significantly. So when markets are high, buy mutual funds. When markets go through a steep correction, like the Liberation Day, markets corrected, then you don't buy mutual fund, NAVs, mutual fund
buy stocks.
units. You buy stocks.
Right.
If you can make this as a principle, you will make sure that your portfolio on the equity side outperforms a more agnostic strategy by 2-3% per year, tested for long periods of time in different methods of testing. So that's one hypothesis which I wanted to put on the table.
All right. And now to my, go ahead.
Yes, please go ahead, Karthik, I'm sure.
No, so I'm saying now to my specific question that when you say whether mutual funds or direct stock picking, depending on whether markets are high or low, and that's a great hypothesis, and I'll definitely remember that. What sectors and what stocks should investors choose when markets are high at a time like we are witnessing right now?
See, I'm liking anything to do with consumption is going to be good because it seldom happens that there is hype and there is tailwind and there is not too much past performance.
Okay.
The tailwind on consumption is very high. The kind of structural changes which have promoted consumption, which will pan out over long periods of time, has also been done. But the consumption stocks are still available if you do bottom-up stock picking. Or on the consumption side, we have 27 funds, 27, 28 funds. You can buy a consumption fund if you wish to beat Nifty by about 4-5% per year over the next 3 years.
All right. So case in point, and the chart that you're seeing on the screen right now, you're saying that markets are high, avoid direct stock picking, but it seems that there is massive correction in consumption stocks, especially auto stocks this morning. Would you still suggest that the strategy should be to buy, let's say, Nifty auto rather than specific stock picking, even on a day like today where there is correction?
So I would say Nifty auto is a better bet because auto is also, I think, buying Nifty auto, buying any sector. See, if you're taking a sectorial call, if you're very sure about the sector, you should buy the index.
All right.
If you're more sure about the stock and the management, you should buy the stock.
All right.
I think Nifty auto would be a better bet, more hedged bet. And if your objectives are simple, to beat Nifty by 4-5% after cost, going the least risk method to achieve that high probability outcome is a better strategy.
All right. And you're mentioning consumption. I'm also looking at the FMCG stocks this morning, and there seems to be a massive correction in those this morning. Hindustan Unilever down about 2.4% or so. Nestle down about 1.4%. Tata Consumer Goods down about 1.2%. Is this got something to do, in your opinion, with this sort of confused MPC decision making that we were discussing about earlier? Is this got something to do with the possibility that RBI may not shave off that 25 basis points in the MPC?
Yes, I think the expectation is that the rates would be unchanged. Even if there's a conducive environment for a downward cycle in continuing, but I don't think this MPC will do that bit. 5.5 would be retained is the current assumption. If that's the kind of environment over the next 3-4 days, you would see some degree of profit taking, especially when the stocks which you read out, I think from a valuation standpoint and PEG standpoint, not just PE, PEG, the growth which is there, I think they're a little more frothier. So I think that's when there is some degree of uncertainty, lesser optimism on the MPC and higher PEG, resulting in some degree of profit taking on these counters.
All right. Final question to you, Feroze, this morning. And this comes to me, by views that some experts have shared on our channel, that markets are potentially not seeing as much retail inflow right now because a lot of investors are placing their bets on IPOs and 40,000 crore rupees worth of IPOs for the month of December. I want to get your view on what investor strategy should be on playing IPOs specifically, because today happens to be the IPO open for Meesho. remember, which opens today and closes on Friday. Price band of 105 to 111 rupees per share, already attracting a grey market premium of about 42 rupees. So specifically on an e-commerce player like Meesho now coming into public markets, public trading, and overall IPOs as a strategy when markets already are at pretty much all-time highs, what do you make as strategy for investors to play in IPOs?
Yes, firstly, I would validate some numerically the thing which you said, retail is not participating. That's so true. If you look at the last 4-5 trading days of November, all 5 days retail has sold mal in the market, in the cash market especially. The 26th November was one of the largest sales, 3,409 crores.
Right.
So retail has been pulling out money to keep their dry powder for these IPOs.
Okay.
Point taken. IPO market, when it dries down, the money comes back into the rest of the stocks, because Indian retail, if you look at the kind of volume, all these IPOs on the first day itself, first few days, they trade 5 times more than the free float they have pumped in. So these investors are very different. Any IPO where retail exits on the first 3-4 days and insti buys are very stable IPOs for businesses which you will own for the long run. Coming back, so the IPO strategy has to be either listing gain for a person or long-term ownership. Long-term ownership is very easy to decipher. In the first 5-7 days, if you see huge institutional buying, then those are the counters where you would want to buy and hold for long periods of time. Coming to one thing which you rightly mentioned, Karthik, I'm taking you back to one hypothesis which I tested and I would like to validate. Like you said, we don't have too much correlation with the US anymore.
Yeah.
I was trying to see which are the periods where Indian markets are correlated to the US.
Okay.
And whenever FIIs have been investing, and FII is the key driver of the current season of the market move, that time US sentiment has a very strong correlation to India. Now, for the last few months, you see FIIs exiting. That's why FIIs are not driving the Indian sentiment. So when FIIs come back in, our correlation with the US will dramatically shoot up at that point in time.
So just one follow-up question on that, and I'm sure, you know, when you correlate that data, there is likely to be a strong correlation. But just one question, that with the rupee weakening and rupee under pressure now breaching that 90 rupees a dollar mark, do Indian stocks become more valuable and sort of easy to acquire for FIIs, because the dollar value gets them more shares, doesn't it?
Yes, definitely from a short-term standpoint, it certainly does. But one thing which has been the problem is, if you look at today's depreciation, it will look like exaggerated because we've reached 90 and this year we have depreciated 6-7% now. But if you see 1st January 2023, we were at 82.64. So the depreciation is about 8 rupees or 7.5 rupees from that point in time. 7.5 rupees on a base of 82 is 9% depreciation in close to 3 years, which is a 2.7% compounded depreciation. So for this year, definitely it has helped. But if you look at long-term depreciation, you're still at that same interest rate parity number of 3%.
Right, Feroze, thank you so much for all those very, very valid points that you have brought to our viewers this morning. And as always, pleasure having you here with us on News 9. Thank you so much.